We keep discussing the Federal Reserve and the implication of the new average inflation targeting by the Federal Reserve that we consider a massive regime change, and the impact of that on asset markets will be very positive. We keep discussing that. In the long term, however, there are risks associated with this. This episode is shedding light on all those aspects. This is the Not Even Wrong podcast. It's September 2nd, 2020. This is Krim Delco. For the day, the fund is down 15.5%. The market was up 75 basis points. For the year, we are up 221.5%. The market is up 9%. We're outperforming by 212%. The point of the Federal Reserve new regime of average inflation targeting is to allow for higher inflation than 2%. The Fed wants average inflation to be 2%, not just stubbornly focusing on 2%, but letting inflation go higher in order to average over several quarters. What that means specifically, since we had below 2% inflation for a while now, and particularly now we're facing that we expect higher inflation and therefore very accommodating monetary policy for quite some time. And this is driving a rally in financial markets. This is driving valuations, particularly of growth stocks. And we just had a meeting this morning discussing all these things and how we should think about it. And also, for example, what it means for our own lives. For example, should we buy a house? And I will get back to that a bit more in detail. But let's talk about the facts and the most immediate impacts that we're expecting. So number one, the Fed is very accommodating to financial markets because the Fed is in the business of creating an environment where jobs can be created. Right now, we have a shock. COVID-19 was a shock to the economy. We have a lot of unemployment. And the way the Fed reacts to that is by opening up the floodgates. And to quote some Fed watchers, and I don't want to go into names, it doesn't really matter. The point is, there's so many people talking about this that I don't want to keep track now of names and bother you guys with details. The point is this: some people are saying that the Fed tool set, which is actually short-term interest rates, in fact is not short-term interest rates anymore. It is the balance sheet, because the Fed is pumping money onto its balance sheet, buying assets left and right, from treasury bonds all the way to corporate bonds, which is driving down yields. And we have a 10-year treasury of 65 basis points. We have a 30-year treasury of 1.35%. This is the yield. This is unprecedented. And with such low yields, we expect continuous accommodation of financial markets and also higher deficits, and therefore also more spending on fiscal policy. Let's go back to some fundamentals. The US has a very large budget deficit, and there are other pundits that are saying that the US really cannot turn those deficits back down, because the entitlement spending on the one side for Medicare, Medicaid, which is basically older people, health and pensions and things like that, and on the other side, the entitlement spending for the army and the military are just things that we cannot turn back, because also we had a bailout of Wall Street in 2008, and therefore people, particularly on the left, will not dial back any kind of spending for entitlement for particularly the more in need type of people, the elderly and things like that. So the bottom line is that we have a spending level which is high, and it's higher than the income of the government, and therefore there is a budget deficit, and that deficit will not go away. Having said that, the question then is, what's going to happen to the debt? Well, the debt is going to keep going up. Now, there are only a few options for any kind of government to deal with higher debt. One is to reflate the debt. That means create inflation and therefore put the dollar value of that debt in nominal terms. You can't do much, but in real terms, you can decline that. So if you have $100 of debt and you have an inflation of 3% over 50 years, that $100 of debt will be worthless. Or if you lend somebody $100 100 years ago and they paid you back today, that $100 was a lot more money 100 years ago than today. So that's the theory of reflating the debt, which is accompanied with inflation. Another way to deal with that is, of course, to lower the spending. But as we just said before, it is highly unlikely that that will happen. And then there's a third one, and that would be to default. But we don't believe that there is going to be a default on US debt, and therefore we have this situation right now that is that we have the most likely scenario is that the Federal Reserve will keep inflating the economy. Now, what does that mean for asset prices? We believe that asset prices will be the first in line to take advantage of that, or another way, the first beneficiaries of the reflationary policy of the Fed will be asset prices will catch a bid, and particularly growth stocks. It explains why Tesla is up, why Apple is up, why all these stocks are up. We will see volatility, we will see uncertainty, we will see people questioning those stocks continuously, particularly the valuations of those stocks. Nevertheless, there is the underlying force which is driving up those asset prices, and that is the demand for those assets driven by the liquidity in the market. We expect down the road other assets, such as, for example, value stocks, also to catch a bid, and things like real estate also to catch a bid. In the end, the idea of the Fed is to put the wealth effect back in place. The wealth effect in economic terms means that as people get more wealthy through the appreciation of their assets, they become more optimistic, they spend more money, the economy gets going, we have growth. Now, the wealth effect has been questioned recently because what's happening in the real on the real side of the economy is that the asset owners are typically the 5 or 1%, and everybody else is in fact a negative asset owner, meaning they have debt. Now, if you don't own assets, you're going to have to wait quite a while for this reflationary game to have a positive impact on you. And that is something I mentioned in a recent episode. We believe that social unrest is a major risk awaiting us because exactly this Fed policy will drive the richer will become richer and the rest will, in relative terms, become poorer. That is a risk the Fed has to take because they don't have other options right now than to reflate the economy, as we discussed just in this beginning of this episode. It's the only way the Fed can help pay back the debt by reflating the economy and therefore lower the real value of the debt through inflation. And inflation shows up in asset prices first, and that is exactly what's happening right now. So for us as a fund, we are long assets that we believe will take advantage of the reflation of the economy. Not just that, I mean, as we discussed in many, many episodes, and the purpose of Orange Capital Partners, as stated, is to generate wealth by investing in disruptive technologies with large impact. So our primary focus is to have large impact and generate wealth with that. It turns out that that is exactly the kind of asset class will take advantage right now of this reflationary policy of the Fed. So the question now as a fund manager is, of course, how far will this go? And I don't have an answer for that. I believe that we have not seen any kind of peak valuation or anything like that. And it can be measured in several things. For example, the skepticism around the valuations of stocks like Apple, Tesla, Amazon is very, very high. So people are still reluctant to accept this reality. And therefore, we believe that there's still a lot of money to be going into those assets. For example, if you want some real numbers around it, if you have a stock like Microsoft, which has been trading traditionally maybe around 25 to 30 times earnings, there is no reason, or we believe that we will see earnings ratios of 60 to 80, if not higher. Stocks like Zoom are already trading at massive, massive higher valuations, and also the same applies to Tesla. Now, the question, of course, is that this whole inflationary policy only helps those companies in the long term or the stockholders, and actually more specifically, it only is advantageous for you as a stockholder if the company in the end ends up delivering and becomes this disruptive force that you're expecting. If not, they will not be able to survive, and then the stocks will suffer, maybe not go to zero, but they will suffer. You can see that in stocks like Uber, for example. You can see that also in stocks like Intel. If you have a problem, your stock doesn't just go up. So you need to be continuously showing results, and then you are kind of allowed to the club of the, let's call them the reflation stocks. I just want to caveat that that doesn't mean you can blindly invest in any kind of growth company, particularly what's going on right now with all these SPACs and all, stocks like Nikola, which in my view are really only slightly shy of scams. So these types of stocks are not going to automatically be beneficiaries of the reflationary economy and policy of the Fed. You have to do your homework. This is what I'm trying to say. But once you've done your homework and you found stocks like we have with Tesla, with Microsoft, and the CRISPR index, those companies are doing real fundamental disruptive work, and they will therefore be beneficiaries of the reflationary policy of the Fed in terms of that their valuations or their asset prices will go up a lot. Now, what does that mean for us as fund managers beyond our fund? It's interesting to think about life in general as a portfolio of investment choices. For example, housing. We at Orange Capital Partners are of the strong opinion that you should not own any other asset than the ones that you own in your portfolio, simply because those are the best returns you can get. And you should rent or borrow money and spend it on all the other things that you need in life, such as housing, car, and all that other stuff. Schooling, for example. Our son goes to public school, so we're not paying for tuition. In fact, we're using the money we're saving for tuition and investing it in Tesla stock. And probably in the future, we'll also diversify a little bit into the CRISPR index. So we're investing in his future and his human capital through the public school system, which in San Francisco is more than enough adequate. And we're also giving him the capital that hopefully will appreciate to a point where he will have independence, both from a human capital and a financial capital perspective, when he is in college or after college. So this is just an example. We're also renters. We absolutely don't believe in going long real estate for owning assets. However, that equation is probably slightly changing, not necessarily in San Francisco, but if you look at, for example, housing in places like Salt Lake City, which is an interesting place that we consider moving to, that place actually has interesting housing prices. Interesting in the sense that you really get very good value, beautiful new built houses in very, very nice locations, very close to the mountains, etc. And you can lower your cost of housing a little bit and still own something. And owning something in terms of housing can be beneficial under the following circumstances. First of all, you have the ability to lever up quite a bit, and it's less risky than levering up in the financial markets. So if you're able to somehow get the equity necessary, for example, if you buy a $2 million home and you put $500,000 down, if you can engineer that $500,000 in a way that it doesn't take away from your holdings in the portfolio. So if you can, for example, borrow against your equity portfolio and then take that as an equity investment into your house, then that could be an interesting proposition. Now, what I'm trying to say is the opportunity cost for us to take money from our equity holdings and invest the cash into the down payment to a house, it's way too high. It's way too expensive. That house would be still way too expensive. But maybe there is a way in this environment to find a way to lower those opportunity costs by not jeopardizing our equity investments. This is hypothetical. I haven't spoken with any brokers, but I believe that given the competition in the brokerage space, there could be a way to, for example, use your equity portfolio as leverage to get an equity injection into the house and then get a mortgage on top of that. Mortgage rates are very low, And then if you add the maintenance and taxes, you could end up owning a $2 million house and spending something along the lines of maybe $6,000 to $7,000 a month, which is roughly what you would pay in a decent place in San Francisco or the Bay Area. And of course, that quality of life in terms of space and freedom and beauty that you would have in a $2 million house at the foothills of the Rocky Mountains in Utah would be much better than an equivalent $2 million house that you can get in the Bay Area. Not saying anything against the Bay Area. I'm just running a hypothetical thought experiment here just to give people a sense that how we think about these things. And I'm just trying to say that at some point down the road, there could be the beneficial situation where you turn from a renter to an owner of a house from a financial perspective. I'm not even talking about the quality of life perspective. If you add that, then it could make even more sense. And on top of that, because the reflationary policy of the Fed, in our view, will drive up asset prices even further and also catch real estate, maybe not now, but maybe in a couple of quarters. The real estate market right now is in an on hold situation because some markets like New York are suffering terribly and other markets are suffering less. But we believe that in a couple of quarters, there could be, at least in certain markets, such as, for example, Salt Lake City, there could be upside, and therefore you could actually benefit by owning something. So to summarize, the reflationary policy of the Federal Reserve is driving up asset prices. We as Orange Capital Partners have taken that view, and we are also heavily invested in that view. We are considering other options for our own private life, such as, for example, owning a house, which could become interesting depending on, as I said, how you structure the financing and also, of course, on the price. But we believe that there are opportunities out there. And in general, the fundamental conclusion of this episode is that the reflationary policy of the Federal Reserve will put you in a position where it's good to own assets. It's also good to have some leverage. And it's good to, of course, always keep in mind, just as a caveat here in the end, particularly with respect to leverage, you have to be able to survive a massive drawdown. You have to be able to survive a very, very sharp correction, because this is the one risk that this reflationary policy will bring with it. It is that there will be a lot more instability in the financial markets. Thank you.